Have you ever felt that nagging sense that something just isn't right with the economy? That we're standing on the edge of a cliff, but no one's talking about it? Or what if I told you that over a century ago, America faced a crisis so severe, so eerily similar to today, that it could hold the key to understanding our future? This isn't just a history lesson. This is a warning. Today, we're diving deep into the panic of 1907, a financial meltdown that brought the United States to its knees. We'll uncover the shocking story of market manipulation, unregulated greed, and a single man who held the fate of the entire American economy in his hands. And as we peel back the layers of this forgotten crisis, you'll start to see the unsettling parallels to our world today. Are we unknowingly repeating the mistakes of the past? Is history about to repeat itself? Stick around, because the answers might just change the way you look at your money, your investments, and the world around you. Picture this. The year is 1906. America is booming. It's the Gilded Age. Railroads are stretching across the continent, factories are churning out goods, and on Wall Street, fortunes are being made overnight. Confidence is sky high. Does that sound familiar? It was an era of incredible innovation, much like our modern tech boom, but beneath this glittering surface, a storm was brewing. The financial system was like the Wild West, unregulated, unstable, and dominated by powerful figures known as robber barons. At the center of our story are two brothers, F. Augustus and Otto Heinz. This is them in their younger days. Augustus, known as the Copper King, was a flamboyant and audacious speculator who had made a fortune in Montana's copper mines through ruthless tactics and endless litigation. He was the kind of guy who saw rules as mere suggestions. In 1907, he set his sights on an even bigger prize, Wall Street. His plan was audacious, to say the least. He wanted to corner the market on the stock of a copper company he controlled, United Copper. The idea was to buy up so much of the company's stock that anyone who had shorted it, betting its price would fall, would be forced to buy it back from him at an exorbitant price. It was a high-stakes gamble, a power play designed to make him an overnight king of Wall Street. And so, on Monday, October 14, 1907, the Heinz brothers and their associates began aggressively buying up United Copper stock. The price shot up, from $39 to $62 a share in just a matter of hours. They thought they had them. They thought they had trapped the short sellers and were about to cash in big time. But they made a fatal miscalculation. They had overestimated their control. The short sellers didn't panic. They didn't rush to buy back the stock. Instead, they just held their ground. By the end of the trading day, the Heinz brothers realized their corner had failed. They were left holding a mountain of overpriced stock that nobody wanted. The next day, the price of United Copper plummeted. It crashed from $62 all the way down to $10. The Heinz brothers were ruined. Now, if this were just a story about a couple of reckless gamblers losing their shirts, it wouldn't be a major historical event. But this is where the dominoes start to fall. You see, the Heinz brothers weren't just playing with their own money. They had borrowed heavily from banks and trust companies. Institutions where ordinary people like you and me, had deposited their life savings. One of those institutions was the Knickerbocker Trust Company, the third largest trust in New York City. Its president was a close associate of the Heinz brothers. The moment news broke about the failed corner, panic erupted. Depositors, terrified that the Knickerbockers' money was tied up in this disastrous scheme, rushed to withdraw their funds. Lines of anxious people snaked around the block, a sea of fear and desperation. This is what's known as a bank run. It's a crisis of confidence. A bank doesn't keep all of its depositors' money in a vault. It lends most of it out. If everyone demands their money back at once, the bank simply can't pay. It collapses, and that's exactly what happened to the Knickerbocker. Despite having enough assets to cover its deposits, eventually, it couldn't liquidate them fast enough. It ran out of cash and was forced to suspend operations. The failure of the Knickerbocker sent a shockwave of terror through the entire financial system. If a giant like the Knickerbocker could fail, who was safe? The panic became contagious. Runs started on other trusts and banks. The entire credit system froze. Banks stopped lending to each other, and they stopped lending to businesses. The stock market went into free fall, plunging nearly 50% from its peak the previous year. The country was careening towards a complete economic collapse. So, where was the government? Where was the safety net? Here's the most shocking part. There wasn't one. In 1907, there was no Federal Reserve. There was no FDIC insurance to protect depositors. There was no central authority to inject liquidity into the system and stop the panic. The entire American economy was a ship in a hurricane with no captain at the helm. Well, almost no captain. Enter John Pierpont Morgan, J.P. Morgan, the man whose name was synonymous with Wall Street power. He wasn't a politician, he was a private banker. But in this moment of crisis, he was the only one with the influence, the resources, and the sheer force of will to command the situation. He was, for all intents and purposes, America's lender of last resort. Morgan summoned the presidents of New York's major banks to his legendary library on Madison Avenue. It was a scene straight out of a movie. For hours, Morgan, with his piercing eyes and imposing presence, locked these powerful men in a room and effectively forced them to act. He audited the books of failing institutions on the fly, deciding which were worth saving and which would be left to fail. He organized a pool of funds, coercing the healthier banks to lend money to the struggling ones and to the stock exchange itself to keep it from collapsing. He basically strong-armed them, saying, "We're all in this together. If the system goes down, we all go down." He was the one-man Federal Reserve for nearly 2 weeks. He barely slept, working around the clock to broker deals, rally support, and hold the fragile financial system together with little more than his reputation and his checkbook. And incredibly, he did it. He stopped the panic. He saved the American economy from total implosion. It's a dramatic story, right? But here's why it matters to us, right here, right now. Let's look at the ingredients of the 1907 crisis. First, you had a period of rapid technological change and economic growth, leading to a sense of euphoria and excessive risk-taking. Sound familiar? Think of the dot-com bubble or the recent frenzy around crypto and AI stocks. Second, you had a complex and interconnected financial system that few people truly understood. With new, lightly regulated entities, the trust companies of 1907 playing a huge role. What are our modern-day equivalents? Hedge funds, private equity, the vast opaque world of derivatives. These are the shadow banking systems of our time, operating outside the full scope of traditional regulation. Third, the crisis was triggered by the failure of a speculative bet by a few reckless players. We saw this in 2008 when the collapse of subprime mortgage-backed securities, a niche market, brought the global financial system to its knees. We saw echoes of it more recently with the collapse of firms like Archegos Capital Management, whose highly leveraged bets went sour and caused billions in losses for major banks. One bad actor can still infect the entire system. And finally, the panic of 1907 exposed the critical need for a lender of last resort. The crisis made it painfully clear that relying on one private citizen, no matter how powerful, to save the economy was not a sustainable model. This realization led directly to the creation of the Federal Reserve System in 1913. The Fed was designed to be the very thing J.P. Morgan was forced to become, an institution that could provide liquidity in a crisis, regulate banks, and manage the nation's money supply to prevent such panics from happening again. So, problem solved, right? We have the Fed. We have the FDIC, we have countless regulations put in place since 1907 and 2008. We're safe now, or are we? Think about it. While we have these institutions, the financial world has become infinitely more complex, global, and fast-paced than J.P. Morgan could have ever imagined. Today, a crisis can spread around the world in minutes, not weeks. We have high-frequency trading cryptocurrencies that exist completely outside the traditional banking system, and global debt levels that are at historic highs. The core human behaviors that drove the panic of 1907, greed, fear, and the herd mentality have not changed one bit. We still get swept up in speculative bubbles. We still panic and rush for the exits at the first sign of trouble. The names and technologies change, but the psychology remains the same. In 2008, the Federal Reserve and other central banks stepped in on a scale that would have been unimaginable to J.P. Morgan, injecting trillions of dollars to prevent a full-blown depression. They did what he did, but with the power of a government behind them. And again, in 2020, they did the same thing in response to the pandemic. But this raises a critical question. Has the safety net itself created a new kind of problem? Does the knowledge that the Fed will always step in to save the day encourage even more reckless behavior? This is a concept known as moral hazard. If banks and investors believe they'll be bailed out no matter what, they have an incentive to take on bigger and bigger risks. They get the profits if the bet pays off, and the taxpayer gets the bill if it fails. The story of 1907 is not just a relic of the past. It's a living blueprint of financial fragility. It teaches us that confidence is the most valuable and most fragile commodity in any economy. It shows us how quickly greed can turn to fear, and how interconnected we all are, whether we realize it or not. So, is history repeating itself? Not exactly, but it's certainly rhyming. The stage is different, the actors have changed, but the script feels hauntingly familiar. We are living in an era of immense financial complexity and rapid change, just like in 1907, and while we have more safeguards, we also have new, untested vulnerabilities. The lesson here isn't to panic, it's to be aware. It's to understand that the system we rely on is more fragile than we think. It's to ask tough questions about risk, regulation, and who ultimately pays the price when the gamble fails. The panic of 1907 is a stark reminder that in the world of finance, those who forget history are truly doomed to repeat it. Thank you so much for joining me on this journey back in time. If you found this fascinating, please hit that like button and subscribe for more deep dives into the stories that shape our world. And I want to hear from you. What parallels do you see between 1907 and today? Let me know in the comments below. Stay curious, stay informed, and I'll see you in the next video.